Imagine looking at this massive, just brilliantly paved 8-lane national highway, right? The traffic is flowing seamlessly. You've got these toll plazas capturing, millions of rupees in revenue every single day. And you find yourself thinking, I want a piece of that infrastructure.
Oh, absolutely. It's a natural reaction.
Right. Or perhaps you're observing a sprawling commercial tech park. It's packed with Fortune 500 companies. They're all locked into these 10-year leases, paying exorbitant commercial rents. And you want that cash flow anchored in your own portfolio.
Yeah, or maybe your focus is on a hyper-growth AI startup, right? You want to be on that cap table before the IPO even happens.
Exactly. But here's the problem. Historically, the capital markets had this velvet rope. To buy into a commercial tech park, you needed institutional billions. To finance public infrastructure, you needed government-level balance sheets.
Right, the ticket size was it was impossible for the average person.
Yeah, to get into a top-tier venture capital syndicate, you needed to be writing checks with an absurd number of zeros. And you had to navigate these private, incredibly opaque networks. For the everyday investor, even a really sophisticated one, those doors were firmly locked.
And, breaking down those walls is exactly what we're looking at today. It's the core pursuit of capital allocation. We are exploring the mechanics of collective investment vehicles,
Which is the mission of this deep dive. We're opening up Chapter 6 of the NISM Portfolio Management Services Workbook, and we're just pulling apart the plumbing of 4 specific structures.
Right, so we've got mutual funds, real estate investment trusts, or REITs, infrastructure investment trusts, or NVITs, and finally, the high-stakes world of alternative investment funds, the AIFs.
We really want to understand not just, what these vehicles are on paper, but how the underlying architecture actually functions. Like, how is the risk managed?
Exactly. And how do the regulatory frameworks dictate what these huge pools of capital can and cannot do? Because the overarching philosophy here, the thing we have to keep in mind, is this concept of securitization and scale.
Scale is everything here.
It really is. It's about transforming massive, indivisible, or totally illiquid assets into fractional tradable units. By pooling capital, you aren't just gaining access, you are fundamentally altering the risk profile through mathematical diversification.
Right, and you're achieving execution efficiencies that are literally impossible for an individual operating alone.
So let's start with the blueprint, the foundational structure of this entire concept, the mutual fund.
The classic.
Yeah, the classic, because for a financially literate audience, mutual funds are often just treated like background noise. We know they pool money. We know they buy equities and debt and issue units based on NAV.
Sure, the net asset value, the daily scorecard. Right. But I want to push past that basic textbook definition, because I look at a mutual fund and I don't see like a charter bus. I see it more like computational cloud processing. Like, it's AWS for capital.
Oh, I like that. That's a highly accurate framework. How do you mean exactly?
Oh, think about it. If I'm building a software company today, I don't buy my own physical servers, right? I don't wire them up in my garage, manage the cooling systems, deal with the hardware failures.
No, you just rent fractional server space from a massive cloud provider.
Exactly. I get enterprise-grade security, infinite scalability, and crazy uptime guarantees for a fraction of the cost. And that's only possible because the provider aggregates the demand of a million other startups. A mutual fund is the exact same thing with asset management.
It does. And the true advantage of that cloud computing model for capital lies in the execution efficiency, and specifically the mitigation of impact cost.
Impact cost. Let's drill into that, actually, because I think a lot of people just assume a mutual fund manager clicks buy on their terminal the exact same way a retail trader does on their phone.
Oh, no. The mechanics are entirely different. When you manage a portfolio of single stocks as a retail investor, your primary enemies are bid-ask spreads, right? And brokerage drag and liquidity constraints.
Right. If I buy 100 shares, I pay the spread.
Exactly. But when an asset management company, an AMC, walks into the market with a 10,000 crore fund, they operate in a completely different dimension of the market microstructure. They don't just buy 1 million shares on the open exchange.
Because if they did, they'd immediately signal the market and drive the price up against themselves.
Precisely. The price would spike before they even filled half their order. So they utilize dark pools, they use institutional block trading desks, and these highly complex algorithmic execution strategies to quietly accumulate position.
Just slowly dripping it in over days or weeks.
Yeah, exactly. Doing it without disrupting the underlying price. And because of their size, they negotiate execution costs down to absolute fractions of the basis point. And that's just equities. On the fixed income side, they have direct access to primary issuances of corporate debt and commercial paper that simply do not have a retail order book. You couldn't buy them if you tried.
Okay, I see the appeal of the institutional pricing. But
Mhm.
let me challenge that scale argument for a second. Doesn't a massive mutual fund eventually become its own worst enemy?
You're talking about size drag.
Yeah, I mean, if an AMC manages 50,000 crores in a mid-cap fund, they lose all their agility. They can't maneuver in and out of a position quickly without causing a massive price impact. Whereas I, as an individual investor with a lean portfolio, I can liquidate instantly.
That is a very valid critique. It's actually known in the industry as the asset bloat problem.
Mm.
You are absolutely right that beyond a certain threshold, size becomes a huge liability in active management.
Especially in the small and mid-cap space, right?
Especially there, because when a fund becomes too large, it can no longer take meaningful positions in smaller companies. There are regulatory limits that literally prevent them from owning more than a certain percentage of a company's outstanding equity.
So they can't just buy up 50% of a great small-cap stock.
Right, and even if they could, a tiny small cap stock wouldn't move the needle on a 50,000 core portfolio anyway. Consequently, the massive fund is forced to just buy larger, more liquid companies just to deploy all that cash.
So they basically slowly morph into a closet index fund,
Exactly. They start looking exactly like the broader market.
which perfectly explains this massive shift we've seen toward passive management over the last decade. I mean, if the active manager has gotten too big to actually generate alpha, why on earth am I paying them an active management fee?
All right, why pay 1.5% for someone to just hug the index? And that's where passive funds, particularly index exchange traded funds or ETFs, come in. They simply accept the reality of the market.
They don't try to outmaneuver it.
No, they just replicate it. They track a benchmark index systematically.
Okay.
Because there's no active stock selection, no highly paid fund managers making guesses, the expense ratios are slashed.
Down from, what, 1.5% to maybe 0.1% or lower?
Yeah, sometimes even lower. And over a 20-year compounding horizon, stripping out that 1.4% management drag is mathematically profound for your total return.
But, and this is where it gets really interesting, the source material spends a lot of time exploring this space that sits right in the middle. It attempts to solve the flaw of human active management, but without completely surrendering to blind passive tracking.
Ah, yes. Factor funds. The smart beta revolution.
The smart beta. I mean, if passive funds are just robots tracking an index, and active funds are humans making guesses, what exactly is a factor fund? Is it a cyborg?
That's actually a pretty good analogy. Smart beta is where quantitative finance intersects with traditional fund management. It acknowledges that human managers often underperform because of cognitive biases.
Like fear, greed, style drift.
Exactly, or just fatigue.
Yeah.
But it also acknowledges that standard passive indices have a critical flaw of their own. They are almost all market cap weighted.
Meaning an index fund automatically buys more of a stock simply because its price has gone up.
Right. Which means it can lead to severe overconcentration in overvalued bubbles. If a few tech stocks balloon to massive valuations, a traditional passive index fund is forced to become a highly concentrated tech fund.
And that exposes you to tremendous downside risk when the bubble pops. So how does a factor fund fix this? Like, is it essentially an algorithmic active manager?
Yes, it is a rules-based systematic architecture. Factor investing is grounded in decades of empirical academic research. This research shows that specific, measurable characteristics or factors consistently explain long-term outperformance in equities.
So it's like setting a smart oven to only bake cakes that have a precise ratio of sugar to flour. It's just a strict, rule-based systematic selection.
Exactly. The algorithm is programmed to isolate and capture those specific risk premia, and it completely divorces the portfolio construction from human emotion.
Okay, the sources highlight 4 major factors here. Let's look at the mechanics of how these actually work under the hood, starting with momentum.
The trend follower.
Right. How does a quantitative momentum algorithm actually operate? Because it can't just be buying whatever went up yesterday, right?
No, it's much more sophisticated than that. A momentum algorithm systematically screens the entire investable universe based on risk-adjusted price performance over specific look-back periods.
Like 6 to 12 months.
Typically 6 to 12 months, yes. It ranks all the stocks and basically buys the top decile. The underlying premise here is rooted in behavioral finance. Markets are notoriously inefficient at pricing in new information quickly.
So when positive news breaks, investors underreact.
Exactly. They anchor to the old price, so the stock price slowly drifts upward over months as the herd finally catches on. The momentum algorithm just captures that drift.
But wait, the churn must be astronomical.
Hmm.
I mean, if the algorithm is constantly re-ranking stocks based on 6-month price trends, it must be buying and selling relentlessly.
That is the defining engineering challenge of a momentum fund, hands down.
Because if it rebalances daily, the execution costs and the tax drag will just obliterate any alpha you generate. So how does it manage that friction?
Well, Krantz designed these highly intelligent rebalancing thresholds. They might only rebalance quarterly. Or they use what are called buffers.
Buffers, like a buffer zone.
Yeah, so a stock is only sold if it drops completely out of, say, the top 30% of the momentum ranking. Rather than selling it the second it drops from rank 10 to rank 11, it's a massive optimization problem, capturing the trend while minimizing the friction.
Okay, I buy the argument for momentum in a roaring bull market, but it feels incredibly fragile. Like if macroeconomic regime shifts happen, say, interest rates spike unexpectedly, momentum funds historically get slaughtered.
They do, because they are universally long the most extended high beta assets at the exact moment the market turns.
Right, which leads us to the defensive factors.
Mm.
How does low volatility operate as the structural counterweight to that?
Low volatility factor funds are explicitly designed to alter the risk topology of a portfolio. The algorithm screens for stocks with the lowest historical variance in price and, crucially, the lowest covariance with the broader market.
So we're talking about utilities, consumer staples, healthcare conglomerates.
It's exactly the boring stuff.
But it's an anomaly, isn't it? I mean, classic capital asset pricing models dictate that to get higher returns, you must take higher risk. But the low vol anomaly suggests that safe, boring stocks actually offer better risk-adjusted returns over time. Why?
The academic consensus is that it's another behavioral distortion. Professional fund managers are heavily incentivized to beat their benchmarks, right? So they chase high beta lottery ticket stocks.
Because they want to look like geniuses.
Exactly. And in doing so, they systematically ignore the boring, stable companies, leaving them structurally undervalued. A low volatility fund systematically scoops up those ignored assets.
So during a massive market drawdown, while the momentum portfolio is experiencing a, 40% contraction, what happens to the low vol fund?
The low volatility portfolio might only draw down 15%. It acts as a profound shock absorber. And mathematically, that allows the portfolio to compound from a much higher base when the recovery eventually begins.
That makes a lot of sense. Let's push on the value factor next. So the algorithm hunts for cheapness, right? Low price to earnings, low price to book ratios, the classic Warren Buffett, Benjamin Graham stuff.
Yes, buying a dollar for 50 cents.
Right, but I've always viewed systematic value investing as just a minefield of value traps. I mean, a company's stock isn't always cheap because it's undiscovered. It's often cheap because the underlying business is fundamentally dying.
The classic value trap.
Exactly. Think of a legacy print newspaper company or a brick-and-mortar video rental chain back in the day. The ratios look amazing because the stock tanked, but the business is doomed. How does a machine distinguish between a temporarily mispriced gem and a structurally dying business?
Well, a pure, naive value factor fund actually doesn't distinguish between them at all.
Seriously.
Wow.
It just buys the dying business.
It will blindly buy the dying business if the valuation ratios are low enough. And you are spot on. That is the severe vulnerability of single-factor value investing. And this is exactly why the industry evolved toward the fourth factor, quality. Ah, okay. So quality is the filter.
Exactly.
Yeah.
Quality is the safety net. The quality factor completely ignores the stock price. It doesn't care if the stock is up or down. It looks entirely at the forensic accounting of the balance sheet and the income statement.
So it's looking at return on equity, debt levels.
Yes, return on equity, debt-to-equity ratios, variance in earnings. But crucially, advanced quality algorithms look really closely at accruals.
Accruals. Meaning what exactly in this context?
They want to ensure that the earnings reported on the income statement actually match the hard cash flowing into the business.
Yeah.
They are systematically screening out companies that are legally manipulating their accounting to look profitable.
Oh, wow. So they're looking for real cash, not paper profits.
Right.
So the natural evolution of all this, obviously, is the multi-factor model. You don't want to bet the house on value alone and fall into a trap.
Right.
And you don't want to bet entirely on momentum and get crushed in a pivot. You want an algorithm that optimizes across all these factors simultaneously. That is the cutting edge of quantitative fund management today. The multi-factor algorithm seeks to construct a portfolio of stocks that exhibit strong momentum, are fundamentally cheap, possess robust balance sheets, and display low volatility.
The holy grail.
It really is. It creates a highly resilient, all-weather portfolio that can dynamically adjust its factor tilts based on quantitative macro indicators.
It's just a fascinating evolution. I mean, we've moved from human intuition to blind market replication and now to this algorithmic rules-based optimization.
Yeah, it's a completely different landscape now.
And here's the pivot, everything we've discussed so far.
Yeah.
Equities, debt, smart beta. It all exists in the realm of paper assets, dematerialized entries on a ledger.
It's true.
But in inflationary environments, or just from a pure portfolio construction standpoint, sophisticated investors inevitably seek hard assets. They want physical infrastructure,
Right.
brick, mortar, asphalt.
Hard assets are a crucial diversifier, but managing physical assets directly is incredibly inefficient.
Oh, it's the worst. I mean, if I want commercial real estate exposure, I do not want to be negotiating with contractors to fix an HVAC system in some office park. And I certainly don't want my capital locked up for 3 years trying to find a buyer for a commercial unit when I want to sell.
The illiquidity of direct real estate is a massive barrier.
Which brings us to the securitization of physical assets, democratizing the concrete, so to speak. Real estate investment trusts, or REITs, and infrastructure investment trusts, NVITs.
The architecture of a REIT is essentially an API for physical real estate.
I love that, an API for real estate.
It takes massive prime commercial properties assets worth thousands of crores, and it fractionalizes the equity. A REIT sponsor aggregates commercial office parks or shopping malls, data centers, places them into a trust, and then lists the units of that trust on a public stock exchange.
Okay, I understand the liquidity argument entirely. I can trade a REIT unit on my phone in 2 seconds, just like a stock. And I understand the diversification. I'm owning tiny fractions of 50 premium buildings across 5 cities instead of 1 residential unit in 1 city.
Right, the concentration risk is gone.
But let's look at the actual cash flows here. If I buy a REIT, aren't I just taking on standard commercial real estate risk but paying a premium for the management? Like, why is the REIT structure specifically so advantageous from a yield perspective? Why not just buy property?
The advantage lies in a very specific piece of regulatory arbitrage mandated by the market regulators. To qualify legally as a REIT, the trust is bound by severe operational constraints.
What kind of constraints?
Well, for one, they cannot behave like speculative real estate developers. They must invest predominantly in completed rent-generating properties. But the absolute most critical component is the distribution mandate. REITs are legally required to distribute a minimum of 90% of their net distributable cash flows back to the unit holders.
Wait, 90%? They are legally prohibited from hoarding cash on their balance sheet.
Precisely. They have to pass the rent right back to you. And the reason this rule exists is to grant the REIT pass-through status for taxation.
Okay, explain pass-through status.
If a normal corporation earns $1 billion rupees, it pays massive corporate tax on that profit. Then, if it distributes the remainder as dividends to you, the shareholder, you get taxed again on the dividend.
Right, double taxation. It kills the yield.
Exactly. But because a REIT distributes 90% of its cash flow, the regulator treats the REIT essentially as a transparent conduit. The taxation happens directly in the hands of the investor based on their specific income tax slab. It entirely eliminates the corporate tax drag at the fund level.
That is massive. That structure creates highly efficient, exceptionally stable dividend yields. Okay, let's shift from commercial real estate to the actual arteries of the economy. The NVIT, Infrastructure Investment Trust. To me, this is even more fascinating than a REIT because, well, you can't just build a new national highway right next to an existing one to compete with it. Infrastructure represents a localized monopoly.
It is the ultimate economic moat. Infrastructure assets, we're talking power transmission grids, gas pipelines, toll roads, telecommunication tower networks. They have massive barriers to entry.
You can't just spin up a startup and build a power grid.
No, they require immense capital outlays and insanely complex government approvals. But once they are built, they generate incredibly predictable, inflation-linked cash flows over decades.
Let's explore the mechanics of how an NVIT actually captures that cash flow. Because they don't generally own the highway the way a REIT owns a shopping mall, do they? They operate under concession agreements.
That is a vital distinction. For an asset like a national highway, the NVIT doesn't own the asphalt in the land indefinitely. They bid for a concession agreement from the government.
So it's like a lease.
Sort of. Say a 20-year or 30-year right to operate the highway, maintain it, and collect the tolls. The financial engineering here is profound. The NVIT uses highly complex discounted cash flow models to estimate the exact volume of commercial and passenger traffic over the next 30 years.
Factoring things like GDP growth, inflation, alternative transport routes.
Exactly. And then they securitize those future toll collections into present-day yields for the unit holders.
But wait, what happens at year 30? When the concession ends, the asset reverts to the government, right? Does the value of my NVIT unit just mathematically go to zero?
If the NVIT only held one single asset, yes, the terminal value would eventually amortize to zero. But NVIT managers are constantly acquiring new assets, rolling over new concession agreements, and expanding their portfolio to ensure the trust operates in perpetuity.
Okay, that makes sense. Now, the source material also differentiates between full-fledged NVITs and developmental NVITs. This seems like a massive variance in the risk profile.
Oh, it's night and day.
Right, because if I'm buying a full-fledged NVIT, I'm buying an operating toll road. The trucks are already driving on it, paying tolls today. But a developmental NVIT, I'm financing the construction.
The risk topologies are fundamentally opposed. A full-fledged NVIT is purely an income-generating vehicle. It operates much like a high-yield bond. You are exposed to traffic risk and maintenance costs, sure, but the asset is operational. A developmental NVIT is taking on execution risk.
Which in large-scale infrastructure in the real world is absolutely terrifying.
It is. You face environmental clearance delays, land acquisition disputes, which can take years, massive raw material inflation for cement and steel, and contractor defaults.
So if a bridge construction is delayed by 3 years, my capital is locked up with zero yield, and the internal rate of return on the project just collapses.
Exactly. And to compensate for taking on that massive execution risk, investors in developmental NVITs demand significantly higher equity-like returns upon completion. You are betting on capital appreciation, not just steady yield.
Okay, so we have the public markets covered. Mutual funds for equities and debt, REITs and invitees for securitized hard assets. All of these are highly regulated, they're deeply transparent, and they're widely accessible to retail investors.
Right. Anyone can buy them.
But the capital markets are not entirely democratic. There's a deeply opaque, highly complex tier of capital pooling that operates way above the retail space.
We are entering the domain of alternative investment funds, or AIFs. This is institutional-grade capital allocation, the exclusive club.
The AIF space is where the traditional rules of finance are largely suspended. The minimum ticket size to enter an AIF in India is legally mandated at 1 crore rupees, though most top-tier funds require significantly more than that.
Usually much more, yes.
My question is, why? Why does the regulator enforce such an extreme capital barrier? What exactly are these funds doing that requires them to be basically quarantined from the retail public?
To understand the regulatory logic, you really have to look at the mandate of a financial regulator. The regulator's primary objective in the retail market is systemic safety and capital preservation.
So they force mutual funds to play it safe.
Exactly. They force them to maintain liquidity buffers, restrict leverage, and mandate daily mark-to-market pricing so that retail investors can exit safely at any time. But the regulator also understands that a dynamic economy requires risk capital.
It needs speculation.
It requires complex, illiquid, and highly speculative investments to fund innovation, restructure failing industries, and provide market liquidity.
And you just can't fund a hyper-growth, cash-burning AI startup with daily liquidity requirements.
No, you can't. If a fund buys a 20% stake in a private, unlisted software startup, they cannot sell that stake on a Tuesday just because a retail investor wants their 500 rupees back. That capital is locked.
So the regulator draws a line.
Right. By setting the minimum at 1 crore, they ensure that only sophisticated investors, high net worth individuals, family offices, institutions can participate. The assumption is that these entities have the financial capacity to lock their capital up for 10 years.
And, more importantly, they have the balance sheet to absorb a total 100% loss without causing systemic retail panic.
Exactly. The training wheels come off entirely.
So let's look at what happens when the training wheels come off. The source material categorizes this universe into 3 distinct regulatory buckets. Let's break down the mechanics of each, starting with category AIFs. These seem to be the funds that the government actually actively wants to encourage.
Yes, category AIFs are defined as funds that generate positive, tangible economic externalities. This bucket primarily includes venture capital funds, angel funds, infrastructure funds, and social impact funds. They are funding the foundation of the future economy.
Let's talk about the mechanics of venture capital specifically, because the return profile of a VC fund is just fascinating. It's not like a mutual fund where you hope your portfolio goes up 12% a year. The VC model relies on a power law distribution.
The mathematics of venture capital are brutal, honestly. A typical VC fund might invest in 20 early-stage startups. The fundamental expectation of the fund manager is that 15 of those companies will go completely bankrupt, entirely wiping out the invested capital.
15 out of 20 just go to zero.
Zero. 3 might achieve mediocre results, basically returning the initial investment.
And so the entire success of the multi-crore fund rests on the remaining 2.
Yes. The remaining 2 must achieve hyperscale growth, hit public market IPOs, or be acquired, returning 50x to 100x the initial capital. Those outlier returns must compensate for all the failures and generate the overall yield for the fund.
It is an exercise in extreme risk tolerance and capital structure arbitrage.
Absolutely. And because the economic value of creating the next major tech giant or the next breakthrough healthcare company is so massive for the country's GDP, the government heavily incentivizes wealthy investors to take this extreme risk.
Right. The government wants that innovation. So what do they offer?
Category AIFs enjoy complete tax pass-through status. The fund itself is not taxed. Furthermore, the government often provides specific exemptions regarding long-term capital gains on unlisted equities to sweeten the deal. The state is essentially co-investing in the nation's future by relinquishing its tax claim at the fund level.
That makes total strategic sense. But then we move to Category 2, AIFs. This is the massive middle ground, and it includes private equity, PE, and distressed debt funds. Now, the government provides no specific tax incentives here.
No, none at all.
I want to drill into the mechanics of a distressed asset fund, because it sounds somewhat predatory to a layperson, like vultures circling a dying company, but it's actually a vital mechanism for economic efficiency. How does a Cat 2 fund actually restructure a failing company?
It is a highly complex legal and financial operation. Imagine a large manufacturing company that has taken on way too much debt. Their underlying operations are fundamentally sound, they make good products, people buy them, but the interest payments on the massive debt are bankrupting them.
So they are heading for liquidation.
Right, which means factories close, workers are fired, and the banks take massive write-downs on the loans.
If a mutual fund held that stock, they would just sell the equity on the open market and run away.
Exactly. But a distressed asset AIF runs toward the fire. They approach the banks holding the non-performing loans. The banks know they might get nothing in a lengthy bankruptcy, so the AIF offers to buy the debt from the banks at, say, 40 cents on the dollar.
Okay, so now the AIF holds the debt instead of the bank, but the company still can't pay the interest. How does that solve anything?
This is where the restructuring happens. The AIF utilizes the bankruptcy tribunals. They force a restructuring where they convert the massive debt they just bought into a controlling equity stake in the company.
Wait, they swap the debt for ownership?
Yes. Suddenly, the company's balance sheet is clean. The debt is gone. The AIF is now the majority owner. They fire the old management, bring in turnaround specialists, optimize the operations, and make the company profitable again.
Because they don't have that crushing interest burden anymore.
Exactly. And then 3 years later, they sell their controlling equity stake to a larger conglomerate or take it public at a massive premium.
That is incredible. They act as the surgeons of the free market, cutting out the necrotic debt to save the underlying enterprise.
It's high-stakes surgery. It requires immense legal expertise, which is exactly why the management fees for Category 2 funds are so notoriously high.
Okay, so that's Cat 1 and Cat 2. Now let's look at the absolute apex predators of the financial markets. Category 3, AIFs, the hedge funds.
Category 3. This is where the regulator essentially says, we will let you use the most dangerous financial instruments available, but we are watching you closely and we will tax you aggressively.
Let's explain what makes a hedge fund so fundamentally different from a mutual fund. It really comes down to 2 specific tools: leverage and short selling. Mutual funds are generally long only. They can only make money if an asset goes up. How does a Category 3 fund engineer absolute returns regardless of market direction?
The defining characteristic of a hedge fund is its ability to separate alpha, which is manager skill, from beta, which is the overall market direction. They often use a strategy called long-short equity.
Walk us through a long-short scenario.
Okay, let's say the fund manager believes that Company A is a brilliant, well-run business, and Company B in the exact same sector is a poorly managed disaster.
A mutual fund would just buy Company A and avoid Company B.
Right. But if the entire macroeconomy crashes, both stocks will fall. The mutual fund loses money despite being completely right about Company A being a better business. The hedge fund solves this by going long, buying 100 crores of company A, and simultaneously short selling 100 crores of company B.
Just for those unfamiliar with short selling, that means they borrow shares of company B from a broker, sell them immediately at the current high price, and wait for the price to drop so they can buy them back cheaper, return the borrowed shares, and pocket the difference.
Exactly. You're selling something you don't own, hoping it drops. Now, observe the mathematics of the long-short pair. If the market crashes by 20%, company A might drop by 10% because it's a good company, resulting in a loss on the long side. But company B, being terrible, drops by 30%.
The fund makes a massive profit on the short side that entirely eclipses the loss on the long side.
Yes. They have stripped out the market risk and isolated their specific thesis that A is better than B.
But the risks they take to achieve this can be catastrophic. I mean, if they're short a stock and instead of going down, the stock price rockets upward, maybe due to a surprise buyout or a short squeeze, the potential losses are theoretically infinite because the stock price has no ceiling.
That is the terror of short selling. And to magnify these returns, they use massive leverage. They use derivatives and borrowed capital to multiply their exposure.
Give me an example of the leverage.
If they find a statistical arbitrage opportunity where they can make a 1% risk-free return, they don't just invest their base capital. 1% isn't enough for a hedge fund. They borrow 10x their capital to turn that 1% into a 10% return.
It's brilliant financial engineering until the underlying correlation breaks.
And when it breaks, the leverage accelerates the losses so violently that the fund can blow up in a matter of days, which is precisely why the government taxes Category 3 funds at the highest possible marginal rates at the fund level.
Right, because they provide no direct social utility like VC funds, and they pose real systemic risks if their counterparty trades unwind.
It's the ultimate high-wire active finance.
Okay, so we've covered the mechanics of everything from retail SEPs to algorithmic smart beta, real estate securitization, distressed debt restructuring, and quantitative hedge fund leverage. But this entire conversation hinges on one massive underlying assumption.
Counterparty trust.
Exactly. I can understand the genius of a long-short equity strategy, but at the end of the day, I am taking my hard-earned capital and wiring it to a corporate entity. The core fear of every investor, from the retail novice to the institutional allocator, is operational fraud.
What stops them from just stealing it?
Yeah. What stops the brilliant AMC manager or the hedge fund wizard from simply liquidating the portfolio, transferring the billions into an untraceable offshore account, and vanishing?
That fear is not theoretical.
Yeah.
It has happened repeatedly throughout financial history. When you look at catastrophic frauds like the Bernie Madoff scandal, the mechanism of the theft was not complex trading. It was a fundamental failure of operational architecture.
How so?
Madoff acted as his own investment manager, his own custodian holding the assets, and his own accountant. He controlled every node of the ecosystem, which allowed him to simply print fake statements while the actual vaults were completely empty.
Which brings us to the final, and arguably most important, analysis of our deep dive. The structural plumbing of these vehicles. The source material outlines a deeply interconnected trust structure governed by the Securities and Exchange Board of India, SEBI. This architecture underpins mutual funds, REITs, infinites, and AIFs.
SEBI engineered this ecosystem based on a singular, uncompromising principle, the separation of powers. It is designed to ensure that no single entity has unilateral control over the capital, the trading decisions, the record-keeping, and the valuation. Let's trace the anatomy of this structure.
It starts with the sponsor. To me, the sponsor is essentially the venture capitalist for the fund itself.
That's a great way to frame it. The sponsor, which is typically a large bank, an NBFC, or a major corporate house, identifies a gap in the market. They put up the initial regulatory seed capital to establish the legal trust, draft the overarching mandate, and seek SEBI's approval.
But their power effectively ends there, right?
Exactly. The sponsor does not manage the money, and they do not hold the assets, they just build the container.
Once the legal container is built, the sponsor appoints the trustee. Now, in reading the source material, the trustee seems to be the most critical yet least visible layer of protection. They are the ultimate fiduciary watchdog.
The trustee holds the keys to the legal kingdom. They are an independent board of directors or a specialized trustee company. Their sole legal and fiduciary duty is to represent the investors.
So they don't pick the stocks.
No, they don't pick the stocks and they don't analyze the markets. Their job is relentless oversight. They audit the fund manager, ensuring that every trade adheres to the SEBI-approved mandate. If a mutual fund is chartered as an equity large-cap fund and the manager suddenly tries to buy high-yield speculative debt, the trustee blocks it.
The trustee then appoints the brains of the operation, the asset management company, or the AMC. This is where the highly paid portfolio managers and quantitative analysts sit. But this is the crux of the anti-fraud mechanism, isn't it? The AMC makes the decisions, but they never actually touch the money.
That is the brilliant operational firewall. The AMC issues trading instructions. The manager clicks buy 10 million shares of Reliance. But the AMC does not have a brokerage account holding the investor's cash, and they don't receive the digital shares.
So who does the AMC actually send the instruction to?
They send it to the custodian. The custodian is a completely separate, heavily fortified financial institution, often a massive global bank that specializes purely in asset safekeeping. The custodian holds the actual cash and the dematerialized shares in a digital vault.
So they actually settle the trade.
Yes. When the AMC executes a trade, the custodian clears the transaction, delivering the cash to the exchange and receiving the shares directly into their secure depository.
Let's play out the fraud scenario here. The portfolio manager at the AMC decides to steal the money. They send an instruction to the custodian saying, wire 500 crores to this random private bank account in the Cayman Islands.
The custodian's automated systems and compliance officers would instantly flag it. They look at the legal mandate, see that the receiving account is not an authorized exchange clearinghouse or a verified redemption request from an investor, and they freeze the transaction.
And then what?
The custodian instantly alerts the trustee and SEBI. Because the brains, the AMC, and the vault, the custodian, are fiercely independent and legally distinct entities, the theft is mathematically impossible to execute unilaterally.
It's an enforced paranoia, and it's incredibly robust. But a system this complex requires immense administrative processing. Who tracks the actual retail investors? If a mutual fund has 5 million unit holders, all executing automated monthly investments and generating dividend yields, neither the custodian nor the AMC has the bandwidth to manage that ledger.
No, they don't. That falls to the registrar and transfer agent, the RTA. The RTA is a massive, specialized data processing entity. They act as the interface between the investor and the fund.
So they're the ones handling the paperwork.
Yeah. Right. They process the KYC protocols, update the shareholder registry, calculate the incredibly complex daily net asset value by synthesizing the custodian's asset data, and issue the account statements. If you log into an app and see exactly how many units you own to 4 decimal places, you are looking at the RTA's data infrastructure.
And when we move from paper assets to physical assets, REITs and InvLETs, the structure gets even more nuanced. You can hold digital shares in a custodian's vault, but you can't put a 6-lane toll highway in a bank vault. So the source material introduces specialized nodes for these physical trusts.
Yes, the trust architecture adapts to the underlying asset. For an NVIT, the trust appoints a project manager. This is the operational entity that actually puts boots on the ground.
They hire the engineering firms to fix the potholes.
Exactly. They operate the toll plazas and manage the physical maintenance of the infrastructure. They ensure the physical asset continues to generate the cash flows that the trust securitizes.
And the most fascinating addition for REITs and NVIs is the independent valuer. In a mutual fund, pricing is easy. The stock exchange tells you what the asset is worth every second of the day. But commercial real estate and 30-year highway concession agreements don't trade on an exchange. How do you prevent the AMC from artificially inflating the value of the properties on their books to make their performance look better and justify higher management fees?
Again, separation of powers. SEBI absolutely prohibits the AMC from valuing their own illiquid assets. They must appoint a legally liable, independent, third-party valuer, typically a global real estate appraisal or auditing firm.
So a third party comes in and audits the buildings.
This valuer deploys teams to inspect the properties, analyze the rental yields, audit the tenant contracts, and build complex, discounted cash flow models to arrive at a fair market value. The AMC has to accept the valuer's independent assessment.
The elegance of this entire multi-layered structure is profound. It's an ecosystem of checks and balances where every participant is financially incentivized to monitor the others. It fundamentally underwrites the trust that allows trillions of rupees to flow from retail bank accounts into the capital markets.
It is the unseen infrastructure of modern finance. Without this rigorous legal scaffolding, the democratization of capital would simply be too dangerous to attempt.
We have unpacked an immense amount of structural finance today. We've explored how mutual funds utilize massive economies of scale and execution efficiency to democratize market access. We dissected the algorithmic precision of smart beta, analyzing how quantitative engines systematically hunt for momentum, low volatility, value, and quality to strip out human bias.
We examined the securitization of the physical world, detailing how REITs and NBITs use regulatory structures and discounted cash flow models to turn monolithic office parks and toll roads into liquid, high-yield digital units.
We navigated the complex, high-risk strategies of alternative investment funds, exploring the J-curve of venture capital, the surgical restructuring of distressed debt, and the highly leveraged absolute return engineering of quantitative hedge funds. And we anchored it all by breaking down the ironclad, multi-node trust structure that prevents systemic fraud.
It is a remarkable testament to financial engineering. The industry has constructed a vast, highly specialized toolkit capable of executing virtually any risk-return mandate, matching capital with economic utility across every sector of the economy.
But I want to leave you with a final thought, a glimpse into where the architecture we just analyzed is heading. Throughout this deep dive, we've examined highly distinct vehicles separated by strict regulatory borders. But those borders are beginning to erode under the pressure of technology. We're already seeing private fractional ownership platforms attempting to replicate the yields of REITs outside the traditional trust structure. We are seeing artificial intelligence deploying multi-factor optimization strategies at speeds human quants can barely comprehend.
It's moving fast.
But the real disruption lies on the horizon. The cryptographic tokenization of real-world assets on blockchain networks. Think about it. If the fundamental goal of a REIT or an NVIT is to securitize an illiquid asset into a tradable fraction, what happens when a smart contract can execute the role of the trustee, the custodian, and the RTA simultaneously? Automatically distributing toll revenues to digital wallets in real time without the need for 5 different intermediary institutions taking a fee.
That would change everything.
Will the complex, multi-layered trusts we rely on today eventually look like antiquated fax machines compared to instantaneous programmable capital? If the friction of capital pooling drops to zero, what previously impenetrable asset class will be democratized next? Intellectual property rights, sovereign municipal debt, the economic value of algorithmic models themselves. The financial structures of the next decade may look completely unrecognizable compared to the systems we use today. It's a structural shift worth monitoring closely as you build your own thesis on the future of capital markets. Thank you for joining us on this extensive exploration and for taking the time to deeply examine the mechanics of your own financial ecosystem. Until next time, keep analyzing the underlying architecture, keep challenging the consensus, and keep diving deep.